To capture counterparty risk in pricing, we will use estimates from credit value adjustments, or in short we call it CVA. So CVA is a market estimate of the measurement of counterparty credit risk. And in concept, this is the difference between the risk-free value and the risky value of a transaction. Or some people would call this the expected loss, okay, arising from a counterparty default. Now CVA is it applies to OTC, over-the-counter derivatives only. And the idea of this is that if, let's say, the risk-free value of let's say a risk-free bond, okay, or risk-free option, okay, is let's say worth $10, in the case where it's risk-free, okay, but if there is a credit risk, then the value, let's say, would drop to $7. So the difference between these two is $3, and this is what we call the CVA. So by knowing by computing the CVA of a contract, we would then be able to subtract it from the risk-free value of an asset or instrument to get the risky value. So that allows us to price risky derivatives. So the standard formula of the CVA is to take the discounted expected exposure of the underlying asset, multiply by the default probability, multiply by the loss given default. So in a way, this gives us a measure of the expected loss in this contract if it defaults. And the risk will vary depending on the depth of the market. So the greater the depth, the lower the risk. Now, because of covariance, the CVA of a portfolio as a whole will always be lower than the sum of individual CVAs. And this is a result of diversification.